You know, right now, the entire world is playing a high-stakes chess match. The prize? Well, it's nothing less than control over global energy. And sitting right in the middle of the board is the US dollar, which, for decades now, has been the undisputed king. But that's the thing. That whole system is now being seriously challenged.
Wow, okay, that's a pretty provocative statement. Pax Americana. What does that even mean? It's the term for this long period of relative peace we've had under US dominance, basically since the end of World War II. So to say it's ending, that's suggesting we are at a massive turning point, a fundamental shift in how the world works. And what's the trigger for all this? A conflict that is threatening the very foundation of the dollar's power.
Now here's the kicker. What makes this whole geopolitical game so dangerous is that it's happening at the absolute worst possible time. See, the global economy was already showing some really serious signs of stress long before this latest conflict kicked off. Those high interest rates we've had, they've been breaking things under the surface for a while now.
So let's just quickly run through these pressure points, because they're pretty serious. First, you've got a $9.4 trillion private credit system. You can think of it as a kind of shadow banking world outside of the usual rules, and it's showing signs of collapse. Second, we've basically hit net zero job creation, partly because AI is starting to replace human workers. Third, the national debt is just growing way faster than the economy can keep up. And fourth, long-term bond rates are going up, which just makes it more expensive for everyone to borrow money. The conflict in Iran? Well, that's the potential match that could light all this dry tinder on fire.
Okay, so the stage is set. The system is already pretty fragile. Who are the main players in this global drama, and what is the prize they're all fighting for?
Well, the US pretty obviously wants to keep things just as they are, keep oil priced in dollars, and hold on to its financial dominance. China, on the other hand, wants the complete opposite. Their goal is to dethrone the dollar and become the one who sets the price for key things like oil. Russia is desperately looking for allies who are willing to trade in anything but dollars, because they've seen firsthand how those can be frozen. Iran is just trying to survive, really, and using its control over a critical shipping lane as economic leverage. Then you have the Gulf nations, the GCC. Think Saudi Arabia, the UAE. They're trying to play both sides, hedging their bets between the old dollar system and whatever this new system might be. And then there's us. Yeah, you and me. Our savings, our jobs, and what we pay at the pump, it's all on the board in this game.
Now, this is where it gets really interesting. There's this theory that countries like China, Russia, and Iran figured something out. They realized they don't have to fight the petrodollar system head-on. No, that's too hard. They just need to build a parallel alternative system that goes around it completely.
And this is basically how that new system works. It's a surprisingly simple three-step transaction. Step 1, a country sells its US dollar reserves to buy physical gold. Step 2, they take that gold and sell it to China in exchange for Chinese yuan. And step 3, they use that yuan to buy oil. The crucial point here, the real knockout punch, is that the US dollar and the entire US financial system are completely cut out of the loop.
Okay, so that's the theory. It sounds pretty clever, right? But is it actually happening? I mean, is there any real proof that countries are doing this? Well, the data certainly suggests the answer is a big yes. Just take a look at this chart. It shows Swiss gold exports to the Gulf countries. See the bar on the right, the one showing the average after 2022? That huge jump happened right after the US froze Russia's dollar reserves. The timing is, well, it's probably not a coincidence. It suggests that when the Gulf nations saw that happen, they had a realization. Hey, our dollar reserves could be at risk too. And so they started turning them into physical gold at a much faster rate.
But here's the catch, and it is a big one. The annual oil market is worth about $4.1 trillion. The entire annual gold market, it's only about $485 billion. That means the oil market is almost 9 times bigger. So think about it. If even a tiny fraction of global oil sales start getting settled using gold, the gold market is just way too small to handle that kind of demand without its price going straight up.
This geopolitical chess match isn't happening in a vacuum, not at all. It's sending some pretty serious shockwaves through the global bond and stock markets, which, as we've said, were already under a ton of strain.
The first place you see the trouble brewing is in what are called bond yields. Look, in simple terms, when bond yields go up, it means the world's biggest investors are demanding a higher interest rate to lend money to governments. They're basically saying, look, the world is on fire and you're spending way more money than you're making. If you want me to lend you my money, it's going to cost you more because the risk is higher. And that is a huge warning sign of economic pain down the road.
And check this out. For over 20 years, the job market and the stock market pretty much moved in the same direction. But right now, look at this. Job openings are collapsing while the S&P 500 is soaring to new highs. The market is essentially betting that AI is going to make companies richer even if all their customers get poorer. At some point, this huge gap has to close. The only question is, which side is going to break first? So all of this puts the U.S. Federal Reserve in an absolutely terrible position. As this slide says, they are totally checkmated. If oil prices shoot up and drive inflation higher, the Fed has an impossible choice. Do they raise interest rates to fight inflation and risk completely crashing the economy, or do they cut rates to try and save the economy but let inflation run wild? There are just no good options left.
So, based on everything that's going on, where does this all lead? Well, it looks like there are really 3 potential ways this whole endgame could play out.
Outcome number 1 is the best-case scenario. The conflict in the Middle East ends quickly, oil prices come back down, and the stock market rallies. Whew, everyone breathes a huge sigh of relief. But, and this is a big but, even in this best-case outcome, the world that comes out the other side is different. That new gold and yuan system, it doesn't just vanish. The dollar survives, but it's definitely weaker in a new multipolar world.
Outcome 2 is, well, it's a lot uglier. This is where the conflict just drags on and on. Bond markets in Europe and the UK start to crack under the pressure of crazy high energy costs. They're forced to sell their US bonds to get cash, which pushes our interest rates even higher. And eventually, the stock market finally wakes up to the pain that the bond market has been screaming about, and we get a massive credit crisis, something like what we saw back in 2008.
And then there's the third outcome. This is the nightmare scenario. The conflict drags on for so long that bond markets don't just crack, they completely break. At that point, the Federal Reserve would have no choice but to print trillions of dollars just to stop a total collapse. But printing that much money during an oil crisis could lead to stagflation. That's the worst of both worlds when you have high inflation and a stagnant economy, or even hyperinflation, where money basically becomes worthless. This is the absolute worst-case scenario. So here's the bottom line. No matter which of these futures we get, the rules of the global financial game we've all been playing by for 80 years are changing. This isn't just about markets, it's about the very foundation of the system. And that leaves us with one final crucial question. In this new game, who is actually positioned to